Good day, friends. We are here today to review the forthcoming IPO from Indian Railway Corporation Limited, IRFC. So, this company is tapping the capital markets with its fresh issue and offer for sale from Monday, the 18th of January. The issue would close on Wednesday, the 20th of January. The issue size consists of a fresh offer, which is double the offer for sale, and the combined offer would roughly be in the region of 4,600 to 4,700 crores in a price band of 25 to 26 rupees. The post issue diluted ownership of the government would stand reduced to just under 87%, and the public would now hold about 13.25% post this issue. So let's dive into the business of the company. The company's activity consists of arranging loans from domestic and international lenders. It has just one customer, that is the Indian Railways, for whom it arranges this loan. This loan is then given to the company in the form of a lease of rolling stock. The rolling stock consists of wagons, coaches, and locomotives. Now, while IRFC has just one customer, that is Indian Railways, this also makes it virtually a monopoly, and it is also a Government of India company. The advantage of this is that it enjoys the same rating, the same credit rating as the sovereign rating, and that is at the highest level that the country has of its rating today. Now, let's move on a little as to give you the size of this company that is going public. The total assets financed by this company so far is 3.66 trillion or 3.66 lakh crores. As far as the AUM is concerned, the current AUM is 2.66 lakh crores, and the funding that the company has done in the current year is just short of 1 lakh crores. It is expected that the demand for funds would take this amount to well over 1.25 lakh crores by the time the year ends. And the rate at which the Indian Railways requires funds and has been growing its business, it would be a matter of time where in the next less than 3 years' time, the AUM from the present 2.66 lakh crores would have more than doubled. Let's come a little to the NAV. The NAV of the company as on 30th September is 26.6, 26.7, in between that. The fact is that this company, because of the lease model that it follows, wherein assets are leased to the Indian Railway for a block of 15 years, and the lease rent is payable biannually, that is in April and October each year in advance for the period, and the company IRFC gets this payment from the union budget effectively through the railways. Now, when you have a lease model, you also have depreciation which gets charged to the books, and the depreciation rates are different as per income tax and as per the Companies Act. Therefore, this company always has a surplus of unabsorbed depreciation. A part of this was allowed to be included in the net worth, a sum of roughly 6,400 crores, which reduced the gearing that the company had done in the current year. Going forward, the gearing would be back in the region of 8 to 10 times the net worth of the company. And this would ensure that as per the business model, the company enjoys very high returns. How does the return work? It gets 6.5%, which is the current GSEC rate on its base capital. On the incremental lending that it does, borrowing money on its balance sheet, it gets 40 basis points as a straight pass-through commission on each leverage that it does. Assuming it does 8 times, we are talking of 3.2%. Added to 6.5, it makes it 9.7%. This is a huge rate of return, and most people or most companies would never hope to earn this kind of money. Because this company does not over leverage, one finds that the capital gearing, or if we look at the capital adequacy, is about 435%, which is a unheard of number, and one would wonder why a company is so under leveraged. With this tax break that I had mentioned on unabsorbed depreciation available to IRFC, what it effectively means is that this company becomes tax-free, because in 2019, the government of India had declared IRFC a infrastructure company and exempted it from paying MAT. This goes a big way in helping this company retain its earnings to a large extent. There is one other thing which investors must know, that this is a dividend paying company, but this company has not declared any dividend so far for the financial year FY21, which means that you already have an accrued dividend of 11 months, which is waiting to be declared once this IPO gets over, which could come in the next 2 months. As per the PSU classification, this company is mandated to declare 30% of its post-tax profit as dividend. So you could easily expect a dividend of around 1 rupee 10 paisa to 1 rupee 30 paisa once the year has ended. So this becomes an added feature to your business. A little more on the business model. After the first 15-year period which expires of the lease, the next 15 years the asset is leased at a nominal value of rupee 1 lakh per annum, which is just flows straight to the bottom line, because the company has more than recovered its value of the asset, the interest on it, and earned depreciation, and the asset is virtually written off. One important thing that I forgot to tell you is the quality of anchor that has come in this issue. The company finished allocation of anchor on Friday. 80% of the anchor book has been issued to foreign investors. The highest allocation has been made to HDFC, which is a little over 25%. It is followed by Nippon Mutual Fund, which has got a little over 21%. The third investor is Government of Singapore through its monetary fund, which has got also a little over 21%. And the fourth investor is Invesco Mutual Fund, which has invested about 13.25%. Besides these four investors who have applied through multiple schemes, there are other investors who have also applied, including the sovereign fund from Kuwait and other investors. Looking at the investor response from anchors, one can be quite confident that even after listing, you'll find a lot of investors who are looking at fixed returns in India and who have in the past invested even in GSECs and call money rates, call money investments in this country would take a fancy for this company. It offers you a little of both. One is the income is directly linked to GSEC effectively, plus the leverage of 8 to 10 times, which makes this company a unique offering. Hope you enjoyed listening to the show. Thank you for joining in.